You're sitting down to do your bookkeeping. You're cruising through all your expenses and purchases from last week, and you come to a couple of your Shopify payouts. You categorize them straight to sales, and you move on. And it feels like you're doing it right. But that one habit is quietly giving you an incomplete and, quite frankly, inaccurate picture of your own business. And today, we're going to talk about why. Let's dive in. Hey there, and welcome to the Boutique Bookkeeper Show, where we take the mystery out of your money and make your numbers make sense. I'm Megan, virtual bookkeeper and bookkeeping coach, and I love helping female boutique owners just like you finally feel confident about the financial side of your business. If you're tired of feeling anxious every time you have to open QuickBooks, or if you're making sales but constantly left wondering, where did all that money go? You're in the right place. We'll cover all things bookkeeping and taxes, all in plain English, so you can be less intimidated by the numbers and finally start to use them to help you grow a profitable boutique. So, if you're ready to stop avoiding this whole numbers thing and start keeping more of the money you make, grab your coffee and your calculator and let's dive in. Hello, and welcome to another episode of the Boutique Bookkeeper Show. I'm Megan, and today we are going to be talking about your Shopify payouts and what is actually inside of them. Now, a little side note, this actually applies no matter what payment processor or point of sale system you use, so you can simply just swap out Shopify, Square, Lightspeed, whatever your point of sale system is, and the information in this podcast episode should still apply to your business. So here's the thing, that deposit that's hitting your bank account looks like one clean number. But Shopify is actually bundling up to 6 separate items into that single payout. And when you record that whole thing as sales, you're collapsing all of that detail into one line and losing information you actually need to understand your business finances. So today, I want to walk through all 6 of those components, what each one means, and why breaking them out separately is going to give you a much clearer picture of what's actually happening in your boutique's finances. So let's start with the first one, and probably the most obvious one, your gross sales. So your gross sales is the full retail purchase price of the product or products you sold. So if a customer bought a $45 top from your store, that $45 is your gross sales. And this is going to be your starting point, and everything else that we're going to talk about kind of builds off of this number. The second component in your payout is any discounts. And I'm a big fan of recording your discounts as a separate line item in your bookkeeping, because when you can see at a glance how much you gave away in discounts last month, that number starts to mean something, and you can see exactly how much value you're handing out through your different promos and sales events. And if that number starts creeping up, you'll know it. The third component is returns and refunds. If returns are a part of your store policy, and for many of you, they probably are in some way, shape, or form, you want to be able to track these separately too, because when refunds are just buried inside of the lump sum deposit, you have no idea if your return rate is going up or down. You can't spot trends. You can't ask yourself why refunds spiked in November. So tracking it separately gives you that added visibility into your business. The fourth component is shipping income. If you do online sales and you're charging customers for shipping, I recommend that you break out that shipping income into its own separate category, separate from product sales. Because here's what that separation lets you do. It lets you easily compare what you are collecting in shipping to what you're actually spending on shipping each month, and that's a comparison that's definitely worth knowing. But it also lets you break out your product sales income from shipping income, so you can easily compare your product cost of goods sold to your actual product sales and not comparing it by the inflated sales that includes your shipping income. The fifth component is extra important, so I want you to pay very close attention here. The next component is sales tax collected. The sales tax that your customers pay at checkout is not your income. It is the state's money, and you are just holding on to it for a little bit until you have to pay it to the state. So if you are lumping sales tax into your sales revenue category, you are overstating your revenue, and that could cause problems on your tax return. Sales tax collected is a liability, meaning it is money you owe, not revenue that you have earned. All right, and the sixth component in your payouts is the processing fees. So Shopify, Square, PayPal, whatever processor you are using, typically they deduct their fees before that deposit ever hits your bank account. So you're already receiving less than what your customer actually paid you. Those processing fees that they deduct are a deductible business expense, and they deserve their own line item on your income statement so you can actually see what you're paying in processing fees. So when you break all 6 of these different components out, your income statement actually starts to tell you something. And I just want to give you a couple of specific examples of what this looks like in real life. So the first one is being able to see your net sales and your actual gross profit margin. When you have gross sales, discounts, and returns all broken out separately, you can calculate your net sales, which is simply going to be your gross sales minus your discounts, minus your returns and refunds. And that number is what you will use to calculate your actual gross profit margin. And your gross profit margin is basically the percentage of each sale that you actually get to keep after accounting for the cost of the product or the cost of goods sold itself. And this is how you calculate it. You're going to take your net sales minus your true cost of goods sold. And when I say cost of goods sold, I don't mean the money that you spent on inventory that day. I mean the actual cost of the inventory that you sold in those purchases. And if you need a refresher on the distinction between inventory and cost of goods sold, go back and listen to episode 31 from just a couple of weeks ago, and I link it in the show notes. That's kind of where we go over the difference between them and why it's important. But I want you to take that number and divide it by your net sales. So once again, take your net sales, subtract your true cost of goods sold, and that number will be your gross profit. Then take that gross profit number and divide it by your net sales again. And the result is your gross profit margin percentage. That percentage tells you how much of every dollar in net sales is actual profit after paying for the cost of the product you just sold. Unfortunately, I know boutique owners who have a solid markup strategy. Maybe they say that they always mark up things, 3 times, and they feel good about it. They think their margins are healthy, but after they actually look at their margins, after accounting for the discounts and refunds and the true cost of goods sold, their margin wasn't even quite at a 2x. So this is a significant difference, and they had no idea that they were losing that much of their profit margin after considering the discounts that they needed to move the product and any product refunds. So it's very important that you break these things out so you can have that type of insight into your finances. The second thing you can start looking at, and I did mention this briefly earlier, that you can start comparing your shipping income to your shipping expenses each month. When your shipping income lives in its own separate category on your P&L, you can put it right next to what you're actually spending on shipping and see what that gap looks like. Now, there's definitely strategies involved here, right? Offering free shipping can help you get customers to add more value to their cart, and that's a legitimate business decision. But it helps to know exactly how much you are gaining or losing on shipping costs so that you can make that decision, an informed one, and not just a guess or a number that you're pulling out of thin air. Before we wrap up, I want to give you a real-life example here just to help bring this whole idea home, because I think actual numbers can make this click in a way that just nothing else does. So I went into one of my actual clients' books and I pulled a quarter of revenue, so 3 months worth of revenue from one of my clients, just to show you what this looks like in practice. So over a 3-month time period, she received a total of $203,831.50 in deposits from the various payment processors that she used. That's the total amount that hit her bank account, and that is what I know quite a few of you may be categorizing straight to sales and calling it a day. But when I took that same 3-month time period and I broke out all of those deposits into the 6 different categories that I covered earlier, her actual net revenue only came out to $194,656.84. So there was a difference of over $9,000. So if I had just been recording her deposits as her sales, her revenue would have been overstated by over $9,000 for just 1 quarter. The biggest cause of that difference is going to be sales tax that's sitting inside those deposits, but because remember, sales tax that she collects, or any of you collect, is not your income. But all 6 of those components do play a factor in that $9,000 difference. If we would have been recording all of those deposits straight to sales, her top line total revenue number would have been $9,000 more than it actually was. And here's what that means when it comes to her taxes. When your income is overstated, your taxable income goes up. And when your taxable income goes up, you pay more in taxes at the end of the year than you will actually owe. So you are literally handing money to the IRS that you do not have to give them when you overstate your revenue on your business finances. Now, I want to be really clear about something because I know some of you are probably thinking, am I supposed to break out every single daily Shopify deposit into these 6 different lines in QuickBooks? And the answer is absolutely not. Do not do that. That would take you forever. And that's not what we're going to do here. There is a much simpler way to handle this that doesn't require you to touch every individual deposit and break it out. But if I covered that in this episode, the episode would get way too long. So that is the process that I am going to cover in next week's episode. I'm going to walk you through the exact method that I use with all of my own clients, and it is so much simpler than you would expect. And this process also lets you reconcile all of your payment processors, so Shopify, Square, PayPal, Sezzle, whatever you are using. The reconciliation process simply means that you are able to make sure that every single penny all of these payment processors owe you is actually hitting your bank account and they're not holding on or skimming money off the top. And it allows you to be 100% confident that you are breaking out all of your sales correctly. So be sure to come back next week for that one because it's going to be a good one. But here's what I want you to take away from today's episode. That Shopify deposit is not just a straight up sales number. It is up to the 6 different categories that are bundled into one. And when you treat it like one number, you lose all of the detail that helps you actually understand your business better. Breaking it out is what gives you the real picture. And just a real quick recap what those 6 components are. It is your gross sales, your discounts, your returns, your shipping income, your sales tax, and your payment processing fees. Now, if this episode made you realize that your bookkeeping might have a few other gaps in it too, I want to direct you towards a free resource that I have, and it's called 5 Mistakes to Avoid in Your Boutique Bookkeeping. This topic that I covered today is literally one of the 5 mistakes that I see all of the time that is covered in that guide. So if you're making this one and you're worried you might be making 1 or 2 other mistakes as well, you can go ahead and grab your free copy at findingfreedomfinancial.com/mistakes, plural with the S at the end. It's a free guide, it's quick, and it's going to hopefully help save you some headaches in your own bookkeeping. But that's all that I have for you today. Be sure to tune in next week for another episode. I'll see you there. Hey there, and thanks for hanging out with me today. I hope that I shared something that helped you feel just a little bit more confident in understanding all the numbers in your boutique business. If you found this helpful, don't forget to go and leave a rating and review on Apple Podcasts. That's the best way for other boutique owners just like you to find this podcast so I can help them feel just a little bit more confident in their numbers as well. If you have any questions about what you heard today, hop on over to Instagram and send me a DM at Finding Freedom Financial. I'll be back again real soon, but in the meantime, go implement or take action on something you learned today. I promise your future self will thank you.